Alrighty, everybody, what is going on? Welcome back to another CYPRX video breakdown. In today's video, I'm going to be showing you guys a recording of one of our private CYPRX community Zoom calls, diving into the fundamental backdrop, going over the macro landscape, and then towards the end, going over technical analysis in both the total cryptocurrency market and XRP. So make sure that you stick around for the entirety of today's call, bringing you guys some of the realest information in the game, starting off this video here with the post that is aged substantially well, tweeting it out to you guys at the most recent local top. And since this post, the market has shed, measuring from the high down to the low, over $200 billion as of time of recording this particular video breakdown, which just goes to show that we are still in a headline-driven environment, that in which one you should be paying attention to. Understanding the macro drivers creating a risk-on or risk-off sentiment intraday in the markets in which you involve yourself is extremely important. So that way you guys can better situate yourselves at discounted prices by understanding the landscape, understanding when is a good time to enter into this market and when is a good time to sit on your hands. So starting here on this post, I said I wouldn't be surprised if the data comes out pushing back on rate cut optimism, sticky inflation, and firm unemployment figures. Then next week at the Jackson Hole Symposium, Powell comes out leaning more hawkish. Let's hope I'm wrong. If I'm wrong and data and Powell continue to fuel rate cut hopes, the rally will likely continue. If I'm right, be prepared for the market to shed a few $1 billion intraday. Part of the game if it happens. Markets don't go up for forever. Don't freak out. Take advantage of some good discounted pullbacks on blue chip digital assets if they come. Markets will eventually find a floor and continue its overall bullish momentum. PPI and unemployment data comes out in the next 15 minutes. And this is again prior to the release of last week's inflation data, which did come out pushing back slightly on rate cut optimism, which just goes to show how important this information is and understanding it. So make sure that, again, you pay attention to today's video breakdown because we're going to paint that entire landscape for you guys in our private community Zoom call. Before we head over to today's video breakdown, I want to leave you guys with this motivational video breakdown. Now, this is for the people that actually want to make improvements in this space. This is for the people that want to take investing and trading cryptocurrency serious. This is not for the Moonboy hype. This is not for the outrageous price predictions and all the influencers out there that are constantly fixating your minds on dopamine-driven content, telling you guys that XRP is going to go to freaking thousands of dollars in the next couple of days, which it's not. Again, humble yourself, have realistic expectations in the market, and actually learn about the markets in which you're operating in. And investing in the space becomes not only much more profitable, but so much easier. So I said here in this post before we jump off and head over into today's Zoom call, the hardest battle isn't with the market, the economy, or your competition. It is with yourself. Discipline over fear, patience over greed, consistency over distractions. Conquer your impulses, and you'll master not only investing, but every part and aspect of life. The first and greatest victory is self-mastery. So I'll leave you all there to ponder with that one. Let's head over into today's Zoom call with the private CYPRX Discord members. If you enjoy this video breakdown, you enjoy these thorough deep dives, actually breaking down the macro data for you all and really putting things into perspective in a way that you all can understand, do me a favor, smash that thumbs up button and subscribe. We do appreciate the love and the support. Reason being because yet again, we are at the forefront of the masses. I mean, I cannot stress enough how ahead of the retail crowd this community is. So we're going to go over that in today's video breakdown. We're going to cover the fundamental landscape. We're going to talk about what to expect this week, risk on, risk off scenarios that could unfold. And we've been pretty damn accurate the entirety of this year covering these things. So just taking a look back at August, all right? Taking a look at the total cryptocurrency market cap. Can anybody tell me before I enlarge the picture, what was one of the primary reasons as to why we were seeing a significant rally heading into the beginning of August and then rolling into the middle of August before we saw the most recent correction in crypto? One very simplistic answer I'm looking for. Can anybody tell me?
Possible records.
Yeah, great job. I don't know who that was that was speaking just then because I didn't see the name, but
Thought you
yeah,
guys would be interested.
yeah, good job, right? Let me mute you guys real fast. One of the primary reasons for the sustainable risk on rally as we rolled over into August was primarily because of the market makers pricing in rate cuts, right? And so you can see here, this is from Saturday, August 2nd in our private Discord. Odds of rate cuts by the end of September have surged, with the markets now pricing in a 92% chance that the central bank will lower rates by then, up from a 64% chance just a week ago. And so, as we remember, at the end of July, rolling into August, we had this correction because the market started pricing out rate cuts here in this correction. We're on the hourly time frame, by the way, on the total cryptocurrency market cap. The market kept and maintained that perspective up until this recent high. And so, just to show you guys, actually, as a matter of fact, I'll ask another question. Can someone give me one of the primary reasons as to why we've seen this recent correction? I'm looking for two answers. One, data related, and two, because of what the market is now pricing in. So, can anybody answer that question? Why did the market recently correct?
Tariffs.
Not quite yet, Patrick.
Is
Slightly.
it because
It
of
is
the
due
hotter
to.
than expected? I'm sorry.
No, 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 you're good.
Oh,
You're right,
oh
Patrick,
yeah.
by saying tariffs because it is tariff related pressures. But go ahead. Who else was speaking just then? Because you were about to hit it on the head.
The hotter than expected inflation data that came out.
Yeah, right. So we had tariffs imposed at the beginning of this year, and now we're starting to see tariff implications lead to higher prices and higher pressures on inflationary metrics, right? Where inflation is still remaining sticky and troublesome in both the CPI and the PPI readings. And so in our private community, just to show you guys that we called this recent pullback, we called the top, and it's not hard to do this. It's very easy. It's not like it's rocket science. So here's my post from Wednesday, August 13th, 2025, when everybody else was euphoric and you got all these Zach Rectors and everybody screaming $1,000 XRP. I said here to you guys at 11:45 a.m. the day before the market corrected, we are still in standby mode, waiting for more data, but cautious is warranted ahead of tomorrow and Friday's headlines. Remember, nothing goes up for forever, and the market to me looks like it may be getting ahead of itself with this high rate cut expectation. And then in this report that I dropped for you guys, I mentioned here you can see August 13th. I like timestamps just to show you guys we're doing this ahead of the curve and not after. I said here, talked about the scenario number three, which would be a pushback on rate cut bets and would be bearish for risk assets if we saw PPI or core PPI surprise to the upside, suggesting sticky producer prices, jobless claims coming in lower than forecast, showing labor market resilience. The market reaction would likely be traders scaling back rate cut expectations, pushing yields higher, strengthening the dollar, and prompting a correction in risk assets. Then down here at the bottom, I said at time of writing, the total cryptocurrency market cap is hovering at a weekly high of 4.1 trillion. This momentum can continue if fundamentals remain supportive, but traders should remain reactive and ready to shift if inflation or labor data pushes back on rate cut prospects, or we get any hawkish Fed comments that dampen rate cut hopes, geopolitical tariff headlines, or any sentiment that shifts towards a risk aversion. And so we got exactly that. So I just wanted to show you guys that before the market corrected, we had talked about that not only in our Zoom calls, but also in our private reports. And so just taking a look at this correction, this arrow right here is where I warned you guys that the correction could take place. This is where the market makers, the day before the news, started to price in that the PPI was going to come out higher. And so they started to de-risk. Here I have written down for you guys that the market makers started to de-risk before the PPI as the PPI data was expected to come out higher. So the market makers sold before the news. And then at 7:30 the next day, you can't make this stuff up. This is the 7:30 a.m. candlestick in the total cryptocurrency market cap right here. Well, the PPI data came out higher, and then we saw aggressive sellers start to take over, and they started to dump more of their positions. All right. And so now the market has slightly stabilized. We found a slight floor at about $3.8 trillion. We have not completely corrected the entirety of the August move. Can anybody tell me why they think that might be?
Rate cut expectations.
Yeah, great job. The market is still expecting rate cuts. However, it's just not at a 92% chance like it was at the beginning of August. And instead, the market is now pricing in an 85 to 80% chance of rate cuts. So as the market started to price out high probability of rate cuts in September, the market slightly corrected that optimism. And now we're currently trading where we're at. So that leads us into last week's report. I just wanted to show you guys, I wanted to read thoroughly through this. This is from August 16th. Reason why I wanted to read last week's report, or excuse me, this was Saturday's report I wrote for you guys, is because now, fast forward to a August 18th report, I just want to show you all that retail is always catching up to us here at CYPRX. So let's go back to August 16th as we wrapped up last week and talk thoroughly through what the market was doing, what we were paying attention to, and then we'll take a look at this report, a retail article now, catching up to what we have already paid attention to in this community, and then we will end it with a forward-looking outlook, talk about what could drive risk-on scenarios this week, what could drive risk-off scenarios this week, and then we'll do a quick TA analysis, and then we'll leave the floor open for questions. All right. So reading our August 16th report, it says here, from Wednesday's peak near 4.1 trillion, the total crypto market shed over 260 billion as hotter than expected inflation data rattled risk sentiment. The trigger came from July's producer price index, which surged 0.9% month over month against expectations of just 0.2%, marking the sharpest monthly increase in 3 years. On an annual basis, producer prices climbed 3.3%, the strongest pace since February. Core PPI, excluding food and energy, matched the monthly surge at 0.9%, further fueling concerns about sticky cost pressures. This upside shot came just as Wall Street had been basking in post-CPI euphoria. Earlier in the week, the July Consumer Price Index showed inflation largely in line with forecasts, rekindling the optimism for a September rate cut. Traders rushed to fully price in a 25 basis point cut and even began speculating about larger moves. But Thursday's PPI print quickly tampered those expectations. Bets on a jumbo 50 basis point cut vanished. While nearly 10% of traders shifted toward a potential hold, this repricing was exactly the scenario that we had warned about in our August 6th Zoom call weeks in advance, where we noted that hotter inflation could weigh on rate cut hopes and expose markets that were getting ahead of themselves. And I reiterated that to you guys in the Discord in this update the day before the news, where I said, it looks like to me the markets may be getting ahead of themselves for high rate cut expectations. All right. We also warned about this in advance before the inflation data on our August 12th report. Down here at the bottom, you can see it says, any geopolitical outbursts, negative tariff headlines, upside surprises in inflation, labor strength, strong U.S. retail sales, or hawkish central bank rhetoric could quickly reverse this sentiment. And this is our August 12th report. On the geopolitical front, a lot of people were speculating that this would drive some market optimism. The Russia and Ukraine and U.S. meeting in Alaska that took place, or the Putin meeting in Alaska with Trump. And so here in this community, we reiterated to you guys that there wasn't really any kind of crazy sentiment that came from this. Honestly, to me, it just looked like a show of force where Trump flew over a B-12 bomber over Putin's head. I mean, that's literally the craziest thing that happened. So adding complexity, geopolitics were also in play. The highly anticipated Trump-Putin summit in Alaska on Friday ended with no tangible agreements. Though both leaders called the talks constructive, President Trump reiterated he would not make territorial concessions or cut a deal over Ukraine, instead calling for a second meeting that would involve Ukrainian President Zelensky. Here you can see some of those highlights in this report. Pretty much just mentions that there were no, positive outcomes. It was just pretty much like okay, we'll meet next time and maybe there'll be a deal. But there's no deal until there is a deal done. All right, announced President Trump. If we come down here, Zelensky was supposed to meet Trump in Washington today. I haven't looked at fundamentals to see if anything has come from that. Clearly, it has not, as the market sentiment today is not really aggressively risk on. As of time of recording, we're still down $71 billion. So I'm just going to go outright and say that no tangible outcome has been announced. As we shift towards this week, so this is what we need to be paying attention to this upcoming week. We have the Federal Reserve Jackson Hole Symposium on Tuesday. we have US housing starts and building permits, so that's tomorrow. And that data as of right now is likely to show some softness as higher rates erode affordability while supply still builds. On Wednesday, we have the FOMC meeting in minutes. Does anybody remember that has been in this community for over a month? Our last FOMC meeting in minutes, we broke that down in thorough detail. We'll probably do the same thing again this week, where we highlighted with yellow, green, and red all the rhetoric from the FOMC meeting in minutes, which is the collective group of perspectives from the FOMC meeting in prior weeks, right? So we'll do that again this upcoming week. We'll get a perspective on whether the FOMC meeting leaned more dovish or hawkish. It seemed like you guys liked that last time we did that, so we'll probably continue. We also have Fed speakers this week. Waller and Bostic speak. So they're going to be delivering hopefully some key signals ahead of September that we need to be mindful of. Whether they come out hawkish or dovish is definitely going to, determine the market sentiment this week. Thursday, we have the Philly Fed manufacturing figures, jobless claims, flash PMI, and existing home sales, gauging growth momentum and labor resilience. So Thursday is going to be of key importance. On Friday, that is going to be our primary focus. Hopefully, I think the market again is getting a little bit too optimistic that Jerome Powell is going to come out and say a whole bunch of stuff because he's used Jackson Hole in the past as a time to do this. But for some odd reason, when the market's like heavily expecting something, it usually does not go that route and goes the complete opposite direction. I'll show you guys that in one of the retail reports that we're going to read here in a second. But Friday, we do have Powell's Jackson Hole speech, which usually is a historical pivotal event. We also have the Bank of Japan to be mindful of this week. The yen last week touched a fresh 3-week high, which is another factor that weighed on risk assets. We know that a stronger yen, i.e. safe haven, tends to weigh on riskier assets like crypto and stocks. This past week, amid hawkish Bank of Japan speculation, Japan revised its inflation outlook in July and hinted at an imminent rate hike by year end. Diverging sharply from the Fed's likely easing cycle, that divergence has supported yen's strength and it fueled further risk-off positioning. Then here I go into a little bit more detail. I just left you all with this by saying that we should stay alert for any renewed Japanese yen strength, driving volatility in global risk assets. As we know, we do have Japanese CPI this week to be mindful of, and any continued rhetoric that prompts a signal that the Bank of Japan is ready to hike rates again could further strengthen that yen and lead to further unwinding again carry trades, yen strength, and correlate to risk asset weakness. So just be mindful of that. So as of now, the total cryptocurrency market cap has stabilized near 3.9. This is that of time of writing. It's now about 3.8 trillion, finding a short-term floor after this past week's aggressive sell-off. The bigger picture remains binary. So we'll talk about these scenarios here in just a second. However, the bottom line is that the week ahead is not just about the volume of data. It's also about the tone of communication from central bank speakers. A September cut was fully priced in, leaving markets hypersensitive to Powell's framing of the outlook beyond September. This is important. I'm actually going to highlight this because this is what I think is going to play the most important role at the Jacksonville Symposium. While the Fed validated expectations of a sustained easing cycle, will the Fed validate expectations of a sustained easing cycle or remind traders that inflation's persistence and geopolitical risks limit room for a maneuver? Meanwhile, the Bank of Japan is emerging as a wild card with Japanese inflation holding and GDP growth resilient. Even small hints of a hike could amplify global currency flows and weigh on risk sentiment. For our community, the remainder of 2025, this is not a moment for euphoria or overexhaustion. It is the moment for disciplined positioning for volatility while recognizing that crypto fundamentals remain structurally bullish. Every macro-driven pullback continues to offer discounted entry points for the long-term accumulation narrative. All right. So we're going to continue to hold that bias as we head into this week. Continuing, at least on my behalf, I can't give you guys investment advice, but I will personally be positioning myself if we do get a deeper retracement across multiple different blue chip digital assets. So now let's take a look at this report 2 days after our report on August 18th from Fortune. I don't know what this fortune.com website is, but it's still a great report nonetheless. And it says, markets had been nearly certain the Fed would cut rates in September, but fresh producer price data is weakening those odds ahead of Chair Jerome Powell's Jackson Hole speech. While investors still see an 85% chance of a cut, Bank of America now expects rates to hold. warning tariffs and sticky inflation could keep policy tighter for longer. Analysts will be eyeing the back end of this week for the market moving news. Markets were hoping for a further signal of their estimations this week at the Jackson Hole Symposium held by the Federal Reserve Bank of Kansas City. Jackson Hole has previously been the site of a tidal change in monetary policy, with spectators widely expecting Chairman Jerome Powell to keep up the tradition at the end of the week. So this is what I was mentioning, where if this is what the market is expecting, is that Jerome Powell comes out and continues his rhetoric like he's had at previous Jackson Hole summits, but this time he doesn't, that's going to create an uncertain environment, right? And the market's going to most likely continue to linger with the current narrative, which is starting to price out rate cuts, right? So just be mindful of that. It's not guaranteed that Jerome Powell is going to come out and say something about monetary policy or where the Fed is headed or what they're going to do in the near future. What I think is going to be the most important thing is not what Jerome Powell thinks is going to happen in September, because that's already being priced into the market and the markets are already readjusting to a lower probability of rate cuts in September, which I personally think is going to happen. I don't think the Fed's going to cut in September unless we see between now and the September 17th FOMC meeting, unless we see lower inflation in all of the inflation reports that come out, or inflation that does not show signs of elevated inflation, and we see every single labor market report come out between now and September 17th higher than expected, right? Signaling weakness. So I'm talking about unemployment claims higher than expected, signaling weakness in the labor market. And then the first week of September, we have unemployment rates. They come out higher. NFP comes out lower, signaling weakness in the labor market. That is the only thing, in my personal opinion, that will lead the Fed to cut rates. If we don't see that, I think the Fed holds. That's my personal opinion as of right now. With that being said, what I think will be of key importance at the Jackson Hole Summit will be what Jerome Powell thinks is going to happen, or what he says to the market, what's going to happen the remainder of this year. So rates on hold September. Does he perceive rate cuts to continue to take place in October or December is what I think is going to be of key importance for a market driver on Friday. Anyways, to continue. A week ago, the chance of a September cut was being priced in at more than 95% by the market. At the start of the week, that might otherwise have firmed that belief. The odds are lower. According to CME Fed Watch Tool, the chance of a base rate cut being lower by one click to between 4% and 4.25% now stands at a little under 85%, with a 15% chance of a hold. Markets are flat this morning as the events of last week, namely President Trump's meeting with President Putin, did nothing to shift the dial on prospects for a better or worse environment. Markets have a good precedent to be looking toward the end of the week. The symposium is held from Thursday to Sunday. For the major economic headlines, Deutsche Bank noted to its clients this morning that the Fed chair's speech at Jackson Hole has often been used to send important policy signals, and it was last year that Powell said the time has come for a policy shift, or for the policy to adjust, before they then cut rates at the next meeting, for the first time since the mid-pandemic. This time around, we don't have the full agenda yet, but the subtitle for Powell's speech on the Fed's website says Economic Outlook and Framework Review. So we can expect some insights on these topics. The notice of framework review is particularly of interest. Henry Allen, a macro strategist at Deutsche Bank, added in his note, the last time such framework concluded was in 2020 and resulted in a shift towards average inflation targeting. Essentially, the Fed will look at periods where inflation had been persistently lower than 2% across the span of the 2010s, for example, and would allow for policy which supported inflation above the 2% target to contract or counteract the timing overall. The Fed has also reinterpreted their approach to full employment, and that a tight labor market alone wasn't the reason to raise rates. So that implied a move away from the preemptive approach whereby the Fed would tighten policy to get ahead of future inflation. As the labor market tightened, Allen wrote, of course, we know that shortly after the framework's review, there was then a major burst of inflation. And although it had many drivers, our U.S. economists concluded on Friday that the new framework was a contributor to that overshoot. So this time around, They expect Powell's speech to call for rolling back the 2020 modifications and restoring a primary role for preemption. If the Fed does decide to take a longer term view on inflation, those hoping for a cut may be disappointed. So, this is exactly what we're paying attention to, right? Keeping in mind, if we just make it logical sense, if the market was pricing in down here at $3.6 trillion, let's go to the higher time frame so it's a little bit cleaner price action for you guys, and let's delete all this stuff, right? So we now know that in the beginning of August, markets were pricing in 95% probability. This is where the market's currently trading at right now at 85% probability of Fed rate cuts. This is where the market was trading at 92% probability of rate cuts. So after this week and after Jerome Powell's speech on Friday, if this percentage drops below 80%, drops below 70%, or significantly decreases away from 100%, what's the most likely outcome? Logically speaking, if there are no other risk on supportive fundamentals, like we don't see a ceasefire announcement, we don't see any positive tariff headlines, and the market data is the primary driver this week, all right, then the likely scenario is that we're going to continue to see either choppy price action, where the market's just going to range. So we're probably just going to see choppy price action where nothing's going to happen this week, or we're going to see a decrease, right? We're going to see a continuation pullback. We're going to see the market shed more weight as market makers continue to de-risk and flood into safe haven assets like yen, gold, and dollar, right? It's only logical to assume that. I'm not calling for some sell-off. I don't think that the market's just going to do this. No. But after this week, if the market perceives the Fed is more hawkish, that they're going to hold rates higher for longer, and it continues to price out a high probability of rate cuts that it was pricing in at the beginning of August, the most likely scenario we can assume is that the market's either going to range or it's going to continue to shed some weight, right? Inversely, if after this week's data, because don't forget we have PMI figures, we have labor market data, right? If all of those figures support rate cut odds and we get a more dovish leaning Jerome Powell, or he provides certainty to the market that even if he doesn't see rate cuts in September, he still keeps the odds of a rate cut probability on the table for October and December if the data supports it, that could allow the market to find a floor where maybe we do see a slight retracement down into discounts for the market makers to reposition at discounted prices to then continue to price in rate cuts later on this year, and the market continues. Or we could just continue to range or continue up from where we currently stand, right? So those will be the scenarios this week, and taking a look at what I said here to you guys. So for a risk on sentiment, ideally, the environment that we would want to see painted for us is Powell acknowledge labor market weakness and frame recent inflation data as temporary. We would like to see unemployment claims come in weaker, reinforcing a slowing jobs market. And we would like to see the markets keep September rate cut odds or late rate cut odds in 2025 on the table. We would like to see dollar pressure, and we would like to see that support risk assets. We also have earnings reports this week. So I threw in there, we'd like to see upbeat earnings reports, positive geopolitical tensions or announcements, and tariff headlines that spark market optimism and create less demand for safe haven. And if we can get those scenarios this week, then it's logical to think that the market's going to find a floor and start to make its way back to the $4 trillion range, where it corrected when it realized it got overly extensive, aggressively pricing in rate cuts. If we get the opposite of that, like I said, that scenario would look something like this. Powell delivering a firm pushback against rate cut expectations, emphasizing flexibility in a higher for longer policy environment, not hinting to the market that he still sees rate cut odds happening in October or December. If we see labor market data coming out supportive of a healthy labor market, while inflation concerns continue to gain traction, especially if US data this week, like the PMI figures, come out higher or firmer, showing strength and resilience in the US economy. Rate cut bets are repriced lower so that 85% probability drops down to, I don't know, 80% or 75%, or at worst case, even 60%. And remember, the odds of a cut in October are now at 15%. If those rate cut odds drop from 15%, which is where they're currently at now, down to like 10% or 5% or a 0% chance, we'd likely see a stronger dollar and we'd likely see more de-risking in equities and crypto, right? And so, again, logically speaking, we'd most likely see the market fail to break above recent intraday highs and start to correct further, or just remain range bound where we currently trade at, not breaking higher, not seeing a continued sustainable rally. We'd likely see some type of scenario like this, where the market would make an attempt to break higher, fundamentals would not support that momentum, and we'd correct, or correct where we currently stand, or just range sideways, right? So keeping this community level headed, it's not time to get ahead of ourselves. It is a continued time right now to be mindful of these things because we are in a headline driven environment. We are not in a utility driven environment where XRP is being utilized for freaking to cover the yen carry trade because of its capabilities, like all these influencers are speculating is going to happen. That's not happening. Like, anytime soon. Definitely not within the next 5 months. The regulatory environment is not going to be clear enough and solidified enough in the next 5 years where if the yen carry trade did rapidly unwind because the Bank of Japan hiked interest rates, right? Regulations are not firmly enough in place where XRP can be utilized by banks all across the world for liquidity provisions, right? And things of that nature. Is it possible in the future? Sure, right? But in the next 4 months, no, it's not happening, right? So we still need to be mindful that we're in a headline-driven environment and that risk assets, like crypto included, are going to be reactive to the headline environment, whether it's risk on, risk off. Okay. So with that being said, as of right now, I have been dollar cost averaging into this recent pullback, not aggressively. Like I mentioned, when we're seeing these slight dips in price that are like 50 to $60 billion on the day, I'm putting $100 here, $100 there. I will aggressively start to dollar cost average in if we can revisit monthly lows. So August lows right now our first bearish targets for aggressive dollar cost average positions. That puts us at about $3.6 trillion, where I will start to aggressively look for some good entry positions. Outside of that, we won't get too overly extensive. The next bearish target, if the sentiment did worsen, would be a full-on retracement down into the July lows of $3.2 trillion. That's a far way away from where we're currently trading at now, and the sentiment would completely need to change, and we would need to see a complete repricing of the rate cut expectations, which we can't speculate on right now because that's not the case. We know that if rate cuts were continued to be priced out, we would most likely see a deeper correction, but we can't jump ahead of the gun, right? We don't want to just start selling positions now thinking that that's going to be what happens, because if Jerome Powell comes out with a complete opposite tone, supports rate cut probabilities, and is like, yeah, we're probably going to cut rates because the inflation's temporary and the data's weak at this next meeting and probably in October and December, then you don't want to get caught selling your positions here because you thought the market was going to do this. But in reality, the market just does something like this, right? So we're not going to get too ahead of ourselves. We're going to take it day by day and be reactive and adaptive to the changing market conditions. That's my current analysis right now, primarily focused on XRP and XPR. So XRP this week in a risk on environment. Right now, we're currently holding at the $2.96 delta. I'm going to remain bullish on XRP above $2.75, meaning scenario number one, we continue to see some slight profit taking up into the Jackson Hole Symposium. Jerome Powell comes out dovish. Labor market data supports rate cuts. PMI figure supports rate cuts. Dollar weakens and rate cut odds remain on the table. And the most likely scenario on XRP is a revisitation up into the most recent sell delta that has held weight at $3.28 as scenario number one. Scenario number 2, we continue to hold weight and find support where we're currently trading at $2.96, and we just range sideways. Scenario number 3 is buyers find a reason to buy at $2.96 aggressively, and we trail higher from where we currently stand, revisiting that $3.28 sell delta. Anything above $3.28, our next area of interest for possible profit taking if you're a day trader, is the next sell delta at $3.59. That would need to be overcome before we can see any higher prices on XRP. Keeping in mind that in an aggressive bullish environment, my highest price target this year for XRP still remains at $5.17. But like I said, we have a whole bunch of sell deltas that we would need to overcome before even talking about that intraday. So for now, if we can remain above $2.75, our next intraday target in a bullish recovery from last week's sell-off holds at 328, immediately above 328, 359. In a complete tone shift, risk off sentiment, the environment completely sours and we fail to break above $3.28. Buyers make another attempt. They fail at that attempt. Sellers show their hand again. That's going to open the door for a revisitation of 275. If we don't see this scenario and sellers start showing strength from here and we break 296, again, 275 is going to be that immediate bearish target. But if we fail to see a buyer attempt to break higher and we create a lower high, that's going to open the door for a full retracement to 256 as our next bearish target. So to the downside on XRP, if we cannot break above 328, 275 and 256 are our downside targets. Outside of that, that's all I have for you guys. Let's continue to just be mindful, stay ahead of the rest of the retail crowd, keep our eyes and ears out for any change and shift in fundamentals that could drive demand for safe haven assets and weigh further on risk sentiment. I'll leave the floor open for questions if you guys have anything. Alrighty, everybody. I hope that you guys enjoyed that video breakdown with insights into our private CYPRX community and the Zoom calls that we host on a daily basis. If you guys are tired of the hopium, you guys are tired of the unrealistic hypey expectations and bullish moonboy price targets, and you actually want to learn about the markets in which you operate in or be with a like-minded community that talks about these things on a daily basis to help you guys understand where we're at in terms of market sentiment every single day of the week, then head over to CYPRXtrading.com. We'd love to have you on the team. And if not, and you want to continue to watch the free content, that's fine as well. Make sure that you are subscribed to the CYPRX YouTube, where we're dropping a video every single day. Make sure that you guys are following us over on X, where we're constantly dropping motivational content, high-end research-based material, not unrealistic, hypey moonboy price prediction bullcrap. And instead, we're really bringing it down to earth, keeping you guys in the loop with ongoing fundamentals and institutional insights. As always, be cognizant, be aware out there, and I'll see you all in the next video breakdown.